Hey everyone, how's it going? BD Investing. Long time since we did this, so let's do the market analysis. First things first, we're gonna look at the SPY chart. But before we do into that, we gotta look at some things. So here's the bearish thesis on the market and why the market has been going down. Obviously, it's because of the Iran war, but from the beginning of the year, the first thing was AI will replace software. So we saw software stocks going down, and that was the first couple stocks to fall were the software stocks, and that was one of the first signs of why tech was weak. Then AI capex, meaning hyperscalers like Amazon, Google, Nvidia spending a lot of on AI, and during earnings, despite that they had great earnings, these stocks were falling because people were worried that AI was a bubble and there was no return on investment. Next, of course, the war in Iran. But the reason why the war in Iran is bearish is because bond yields, which is the interest rates, are nearing 5%. And the next is oil's rising, inflation's rising. And we're going to if you didn't do the course, when inflation goes up, right, because of oil's rising, the inflation, when inflation goes up, then guess what? The odds of interest rates go higher. And if interest rates are going higher, that's very bearish for the market because if you can only learn one thing about the market, it's monetary policy, meaning macro and interest rates. And if interest rates are low, then the stock market go high. And if interest rates are high, then stock market goes low. And that's because people borrow money to invest in the market. And if they're making less returns on the market and they have to pay more interest, well, guess what? They're going to sell stocks to pay back their loan. And then, of course, the interest rate cuts, the odds are low, and we're going to go over that. But first, I want to go over the SPY chart because it's important we go over it. I posted about it in market analysis. If you want to just take a quick look at that. But the thing I have drawn over here are key levels of where we usually see the market bounce. So a 10% drawdown, all right, and we're about to see that in the S&P 500. We're just 1% shy away from a 10% drawdown correction, but on the Nasdaq we are already in a 10% drawdown, all right? But for the S&P 500, um, usually the market bounces or reverses, and a bottom is made when there's a 10% drawdown. But looking at this chart, and when we're looking at the 2025 market and we're looking at the 2022 market, I'm thinking we go a little bit lower, and we possibly test the 2025 pre-tariff highs at 613. I think that's where we're gonna go, and I made the trend line here. And that's possibly where we test. We might go down a little bit here, and then we might reverse, and it's something we actually saw happen around here. And I believe it's on the daily chart because this is the weekly chart. I believe you can see on the daily chart. Yes. So back in the April tariffs, what happened was when the market went down, it found a relief at 565, somewhere around here, which was a 10% drawdown. We saw a little V shape. It trapped buyers. People were bullish all of a sudden. It even tried to hold the 200-day moving average, and then boom, we saw the crash. And I think that's what's gonna happen here. I don't think we're out of this war. This war is, there's ground troops, and this could possibly take months, right? We could be seeing a 2022 Russia-Ukraine market scenario. Again, I'm not a geopolitical expert. I don't know what's gonna happen. Maybe Trump finds a deal, does something, tacos. So it's really hard to say what's happening, but we are trying to prepare for the best, and we are in the game of probability and odds. So that's the best case scenario. And we're going to use, our macro technical analysis and quantitative analysis in this scenario. So, but what, based on the charts and not looking at, news, the most important place to look at would probably be the 50-day weekly average. And every time we broke below the 50-day weekly, there was a crash assumed, right? Every single time we broke the 50-day weekly moving average, a crash assumed. Back in 2022, tariffs, and all that, right? So, but let's say tomorrow we get a nice, taco. Trump says there's a deal happening. JD Vance is in Pakistan, maybe something bullish, and we get a bullish engulfing candle. The S&P and Nasdaq are up 2%, 3%. and we break above this 50-day moving average, weekly average is 645, and we stay around here, then maybe there's a possible chance that we don't have to exit certain stocks and we can stay in this game. But the most bullishness is after we break above the 200-day moving average, which is above 661 or wherever we get around here. Right? So that's the only hope I think we have in the market for this to not be a crash. But let's say we test this level, still no news. I think we are going to go for the full 20% drawdown. But my opinion is if you're a long-term investor, at each of these strategic levels, you want to be buying. I don't think we're going to get the 30% market crash. But if we do, we'll be breaking below the 200-day weekly moving average, and they say every time the best time to buy is below the 200 weekly or close to the 200 weekly moving average. So if we get anywhere near 517, I suggest people go super bullish and buy stocks to a crazy, just you better be buying stocks. So at each of these levels, I think this is probably the best time to be buying Magnificent Seven stocks, buying all the stocks that we own. All right, and we also have them in the stock picks. But I think if you're looking for more ideas of what stocks you should be buying, you should be going to the stock ideas tab and just be looking through all of that. It'll tell you which sectors are still hot and which stocks you should be buying. But you can always go to the BD Investing Stock Picks, which can be found in BD Portfolio Stock Picks. I'm going to update and post the stock picks, but you can just scroll up and you can see all of these stocks that I think are still good stocks that are trending in this bull market. So something else I updated over the weekend was that the fact that we might be looking at buying fertilizer stocks, because back in 2022 during the Russia-Ukraine war, we saw that corn and wheat and fertilizers, they all started pumping up because it was a long war and there's shocks in the market, especially for supply shocks. So corn is kind of trading low right now, so I'm thinking about buying some leaps on corn and possibly buying Nutrien, CF, Mosaic company. So stay tuned. But if you want to look at it, definitely look into, I did a whole bunch of research thanks to Claude. Claude helps a lot. So this was, a little bit of some sheets we made, and you guys can take a look at that. I also posted like a full playbook on stocks that went up during the 2022 bear market. So if this is a war-driven stock market, these are the stocks that could be doing good, especially oil, gold, And we also have the US stocks that could be doing very good in this market. So definitely take a look, guys. Maybe you get an idea. Maybe it sparks your own, train of thought, and maybe you find a way of how we can survive this market and what edge we can have. But this is the edge I found, and we'll most likely be going with that, and we'll see what happens with the market. All right. Next, I want to go over inflation. So the reason why the stock market, why I'm kind of nervous and why I think that, why is BD cutting his positions? The reason why we're cutting positions is because the whole market is driven by inflation and interest rates. And if interest rates remain low, then of course we continue to be investing in the stock market. But if the odds of interest rate cuts are down and most likely interest rates are going higher, then we need to de-risk, because I'm telling you guys, never have you seen a market where interest rates go up and the stock market continues to go up. It barely ever happens. So yes, if we have to cut positions, I will, and I've marked down some stocks that I will be trimming. Notably Oscar, I will be getting rid of Oscar. The only reason why I'd be getting rid of Cloudflare is because I've performed so well on it, and it's the only stock that's still trending higher, and I think it's lagging, so it could go down. So I might as well take some profits out of Cloudflare and Oscar. And of course our moonshots, we already de-risked most of them, but I'm thinking about cutting them completely, despite the fact that I still love all these stocks. Rubrik I might not cut because I'm down 30% on it, but the rest of them I will be looking for a pump and possibly de-risking. But I still like Nebius, I still like ASTS and Rocket Lab because of the SpaceX IPO. So we'll see what happens. But I suggest you guys all start de-risking and raising your cash position. I would say don't raise it more than 30%. Mine is 12%. I might be raising it to 20%, but don't be raising it more than 30% because anything can happen in this market. If you have a cash position of 75, 85%, I suggest you start buying stocks, especially stocks like Google. Sorry, not Google. Stocks like Google, Amazon, Meta, the ETFs, and stocks that are trending higher for us. Now back to inflation. So the Cleveland Fed is actually predicting a 3.6%, 3.16% rise in inflation. And we get the inflation report about next week. All right. Now, last month's inflation was 2.4%. We're going to see a jump all the way to 3.1% or 3%. All right. That's almost a 0.6% increase in inflation. And that's kind of scary because that's going to make the chance of a rate cut almost to zero. But this could be temporary because we also saw inflation rise back in October, and it was just a a little bump in the inflation, and then we came back down, right? So it could just be a little blip. We saw that same thing happening back in 2023, and inflation was trending higher, but then it went back down. So we'll have to pay attention and see what really happens. But poly market is probably the best place to see what will happen because it will say poly market says how many Fed rate cuts in 2026, and the odds are jumping to zero at 40%. So if this trends all the way to 100%, well, that's very bad for the market. If we see odds of Fed increasing the rates, well, now the market is cooked. All right. Another thing we gotta look at is the reason why I'm still bearish on the stock market is because Nvidia is only down 21% and Apple is only down 13%. So I feel like these two still have to fall a lot more. And if we look at the Nvidia chart, all right, we're seeing a bearish head and shoulders pattern on the daily chart, and it's breaking below its 50-day weekly moving average, and that's very bad. Like if it cannot hold above 169, we are going to be falling into the buy zone of 170, 140, and most likely we are probably going to go down to, let me see. Yeah, we're probably going to be testing the previous levels around 145, 130 possibly. We could even go down to 1010 if, the worst case scenario, but it's very important to see what we do at the 50 weekly moving average. Nvidia needs to stay above 170. This is the market where, you just have to close the markets for a while, buy the dip, and go about your day. Can't do much. Same with Apple is testing a huge support of 200-day moving average. We need to stay above 250, but honestly, shorting Nvidia and Apple wouldn't be the worst idea. So on the next green day, this is probably the two stocks I would short, just to generate some alpha in the market. But yeah, let me actually show you guys corn and why I'm kind of bullish on corn. We're kind of seeing some upward momentum on that. So we could see that the trade is alive, and we could possibly go into that corn trade. So I'm thinking what we do here is we short Nvidia and Apple, long corn, and long the fertilizers, if that's the alpha you want to play in the stock market. But anyways, guys, we'll see you tomorrow. Let's look for a relief bounce and possibly make some exits on some stocks and try to maintain a 10 to 20% cash, but also try to be buying dips on long-term stocks because it's not the end of the world with this market. We'll be fine. All right.